So I think we got some good news and some bad news when it comes to the housing market, real estate, and also rent prices as well. Recent developments have been released. I don't know if you guys are aware, but mortgages are on the decline. Mortgage applications, we know that they are on a decline. Interest rates are up and home values are relatively high. And this is creating a extreme imbalance with buyers' confidence and ability to even afford these homes. Now, this is going to have a huge impact and effect on so many buyers, sellers, mortgage brokers, real estate agents, moving companies, underwriters, closing attorneys, title processors. Like everybody is actually going to feel some impact from this somehow, some way. But what makes it even worse is that Fannie Mae and Freddie Mac have actually initiated a change in how they're going to go about underwriting mortgages and ultimately approving or denying applicants and or determining what their interest rate will be. As typically in the past, the higher your credit score, once you cross 740 or above on your credit score, and this is an average between all three bureaus, Experian, TransUnion, and Equifax, you would be in the top tier and you would get the best rates. So now they're doing away with that, and they are introducing something called FICO or FICO 10T, which does away with the traditional credit score and is actually going to take a deeper dive and look at your credit history for the past 24 months. This is a big deal because previously people would make changes to increase their credit score right before applying for a mortgage to get the best rates, and then they would then probably go back to what they were doing, increasing their debt levels on their credit cards and revolving account balances and things like that. But now they're saying, no, we don't want people to do that and pretty much take advantage of the system and, basically pull the wool over our eyes just to get the approval and then go back to being high debt risk for the banks, which is something we've spoken about before. And I've discussed before, the banks are going to position themselves to protect their interests and their money because they can't afford to have defaults. They can't afford to have bankruptcies. They can't afford to have charge-offs. They can't afford to foreclose on properties. And, we can't afford to have it happen either because ultimately if that were a huge widespread problem, we would all feel that pain through bail-ins and other increased fees and charges and things like that. So they're changing it to the point now where, all right, they're not going to make you use all three credit bureaus, just two, but they're also not going to let you just fix your credit a month or two before you apply. They're looking back 2 years. So if you're carrying debt, if you got late payments, if you've got charge-offs, if you got delinquencies, if you got collections, if you got negative marks on your credit 2 years prior, this is going to hurt. And it's going to hurt so many people because buyers need credit, they need financing, they need mortgages, but the sellers need it too. The sellers need the buyers to have the ability to get it so that the sellers can sell their properties. Michelle sent me one this morning. She actually sent me a few this morning as we are currently looking for our next real estate investment here in Florida. And, she sent one and it was nice. It was nice. But I told her, I said, this house, they're never going to get the price they're asking. And there's a multitude of reasons why this particular house is not going to get it. Not that there's anything wrong with the house. It's just that the house is, in my opinion, overpriced for what it is. And the comps are not going to support it. There will be very little competition in contracts. This house has been sitting on the market, according to Zillow, for 111 days. Whereas previously, as soon as you listed a property, you'd have multiple offers, and then, it would literally be on the market for about 3 days before it was under contract, just as you're sifting through them and finalizing the deal on who's going to end up being the buyer. And this home has been sitting on the market for 111 days and has seen multiple price reductions, but it's still too high. And it's too high in relation to the price per square foot and how the interest rates would have an impact on the monthly payment for the property. So with Fannie Mae and Freddie Mac now making it harder, more than likely, for people to be approved for mortgages, this may probably have more of an effect on driving down home prices than the higher interest rates, than the Fed and Jerome Powell's push for higher interest rates to force sellers to sell. And I think that this is going to have a greater impact than interest rates because it's just going to eliminate so many buyers and or reduce their buying power, forcing the sellers to make accommodations to the buyers if the sellers really want to sell, if they really have to sell. And in this one in particular, it was actually they bought this home, I believe, in 2019. So they bought it for a reasonable price, in my opinion. They didn't buy it for the inflated prices of 2020 and 2021. And so they have some wiggle room, in my opinion, probably, unless they refinanced it, did a cash out refi against the increased equity on the property during the pandemic. That could bite some people in the butt. But if not, and they are just sitting on 2019 prices, they could still sell for a profit, but they're not going to get what people were getting in 2021. They're not going to see those huge capital gains on real estate. They kind of missed the boat. But with that being said, I think a lot of people missed the boat. I think anybody trying to sell right now, they're at a disadvantage. It's not a buyer's market. It's not a seller's market. It's just kind of a crappy market. And there's so much confusion and uncertainty and speculation and fear and worry in the future that it's just going to continue to be that way, I think, in this really weird, funky, gray area, which then talks more to rentals. A lot of people believe that this is going to force homeowners, to become landlords because they can't sell. They'll just rent. They'll rent out. Buyers can't buy. They'll just rent. Builders sitting on a lot of inventory, possibly not sure what they're going to do. They are in a tight squeeze and they have construction loans that have to be paid back relatively quickly and really can't afford to sit on them too long. And their carrying costs and the interest that they would accrue or balloon payments. So I honestly think that we'll probably see more rental opportunities come about. But with that being said, I also think that the rent prices are probably going to stabilize or possibly even come down, seeing as how inflation is going up, consumer confidence is going down, disposable income is going down, debts are increasing, and for the people out there, let's just say you have a neighborhood, a community, a zip code of homeowners looking to sell. And they say to themselves, well, the home prices are too high. We can't sell them for what we need to sell them for. We can't sell them for a loss because we can't take that loss or we don't have the cash to cover the difference in the negative equity from the sale. And the buyers aren't buying because the interest rates are too high. So we'll just rent our homes. Well, now you're going to be renting your home in a neighborhood, in a community, in a zip code, in an area, in a market where everyone else is doing the same thing, or a lot more people are doing the same thing than were in the past. So now your 3-bedroom, 2.5 bathroom home, your 4-bedroom, 3-bathroom home for rent is up against similar comps in the neighborhood, in the area. So now the renters are going to say, well, we have the ability to shop and get the best price on rent, which then forces the homeowners who couldn't sell, that are now thinking about and contemplating renting out as landlords, to then become aggressive with their rent prices and see those come down. And I think this is just going to be a continuous cycle, which could theoretically push towards this housing market bubble deflation that I was talking about, but it may actually push towards more of a home ownership landlord situation and increased rental market for the foreseeable future, probably for like at least the next 2 years. But these are rapidly evolving changes. And just as we see this new Fannie Mae, Freddie Mac push for FICO 10T, we could see a shift and a change next month, January, next spring. Anything could happen as the banks, as the economists, as the Federal Reserve, as the legislation, as the current administration all try to push towards fixing the economy. We could see anything happen. I mean, shoot, we've even seen Bank of America talk and make reference to eliminating credit scores and the need for credit scores and down payments on buying homes, which, some people are saying, this is a way to get a free house. Basically, you can get a house without any money up front, no cash out of pocket, no down payment. And literally all you're going to have is your monthly payment moving forward. And that's like a free house, so to speak, without having to pay closing costs, without having to pay a down payment, without having to shell out cash out of pocket, which a lot of people just don't have. When it comes time, like especially first-time home buyers, and you're talking about, you need 2.5%, 3.5%, 5%, 10% down, depending on which loan program you're going for, on a $300,000, $400,000, $500,000 house, which is now like a starter home price. Back when I got my first home back in 2010, we paid $135,000. But that house today is like Zillow's estimate is $370,000. So first time home buyers are like, yo, look, number one, the credit situation is a mess. Granted, I was watching Mr. Beast this morning. He was promoting Experian, I believe. So this is still a good time. Like, it's never a bad time to make sure your credit is in check. So making sure your credit is in check and making sure you don't have any negative remarks or accounts or notes or anything on your credit is going to be vital. But with that being said, the credit game is a mess. FICO 10T is going to be a game changer, and people, their income is pretty much stretched to the max with inflation and higher prices. And, interest rates are going up, making everything more expensive to borrow money. And if you guys are paying attention, you see the continuous cycle and the path that we're on, which just can further solidifies and, proves my point that if you're not spending less money, which is extremely hard to do right now, you ought to be making more money. And if you're not making more money, what are you doing? And, I'm posting videos, I'm putting up information, I'm sharing content, I'm sharing information. Look, guys, the opportunities are out there. You can increase your income. You can make more money. You can generate passive income, side hustle, small businesses on your own. You can connect with brands and businesses and other opportunities to see direct deposits in your business checking accounts on daily, weekly, monthly basis. And I'm living proof of it. I do it every single day. I've been doing it probably for the last 3-4 years. And, granted, you're not going to start out day one just automatically making $1,000 a day. But I tell you what, the sooner you start, the sooner you have an opportunity of getting there. If you want to know more, hit me up, join the group, comment down below, check out this video, watch the playlist, subscribe to the channel if you haven't already. You guys take care, be safe. I'll see you real soon. Bye.